This is going to be a stock analysis update for Star Energy. Star Energy operate lots of conventional onshore oil fields throughout the UK. They have these wonderful Texas-style oil wells throughout the UK, and they're also looking to expand into geothermal energy. Before I start this video, please remember that I do these videos just as a hobby for fun, and make sure you speak to a qualified financial advisor before making any investment decisions. So as you can see, 92% of Star Energy's revenues come from oil, with about 3% from electricity and 5% from gas. The electricity is interesting situations where they have rigged up at gas wells that are producing quite a small amount of gas. They have little power stations there to produce energy for the local grid. But the mainstay of their revenues come from these onshore oil wells. They're mostly concentrated in the East Midlands and the Weald Basin. And here you see a nice little map of where those wells are located. They've done a really good job of keeping their production at above around 2,000 barrels per day. They do that using these life extension projects. And you can see that they've actually been able to keep, as well as oil production, their actual reserves are staying around the same over the last 5 years. They're doing a really good job extending the life of each of these resources. And it is quite impressive. I think they're doing quite a good job there. They actually own the exploration rights to around 27 trillion cubic feet of shale gas. And that is actually enough gas to supply the UK, to supply the whole of the UK for around 9 years. I actually invested into Star Energy. They were called iGas back then in 2022 when Liz Truss got into power, because she had promised to allow the development of shale gas through fracking. However, unfortunately, when she got ousted from government and Rishi Sunak came in, he then banned fracking almost immediately. So this then led to the collapse of the share price. This was one of my high risk, high reward bets, and I allow myself one of those every year. And although it was only a small percentage of my overall portfolio, I lost a good 80% of that investment. And this making iGas, who are now Star Energy, actually the worst trade ever for me since I started doing this channel. I made the mistake as well of not selling when I could have up here somewhere, and there's definitely some lessons to be learned there. But the amount of shares I own in Star Energy are so minute, they're not even really worth considering as part of my portfolio. But the whole purpose of this video is, given that there's a large disparity between their market cap and their oil assets that they are going to be able to extract from the ground. They have actually a price to book of only 0.2 at the moment, and I'm taking a look at them to decide if, based on that huge disparity from just their conventional resources alone, are they actually a good candidate for my high risk, high reward bet for this year? They are also looking to expand into geothermal, and they bought GT Thermal in the UK in 2021, who have some geothermal projects in the UK, and they've also just bought this year 51% of A14 Energy in Croatia, who have several projects over there. So they are looking for, when the oil begins to run out, and within like 30 years, their current resources should be quite diminished and depleted. They're looking to move in, they're looking to step into geothermal, so to ensure that they can continue with their revenues in the future when the oil starts to run out. So looking at their conventional, and in 2021 they had their Scampton North and Welton waterflood projects, and as you can see, these did add substantial resources to the company. In 2022, they had the Stockbridge Revival project, which has added 200 barrels per day. And this year, they just very recently actually got planning permission for their Glentworth field extension, which is another 200 barrels per day. This will in the future be extended to a phase 2, adding 500 barrels per day. And a target for this year is this Corringham infill drill, which will add 100 barrels per day, which is supposed to start this year. And then they've got identified in 2025 this gas to local grid project, where they have a little power station there turning gas from that resource into electricity to supply the local grid. And they've also identified Singleton and Abington as future targets. So they're doing a very good job at working at all these end of life assets to get extra resources out of them. And this is how they've managed to keep their reserves actually fairly elevated over time and prolong the period before they start going into a kind of terminal decline of the resources. And this way, they've managed to keep their production every year up and then their revenues up. So, in terms of their conventional assets, I think they're doing an excellent job. I took a look at their competent persons report, which is independently produced. And I did this not just to double check their numbers for their NVP 10 values, but also to see what's the kind of profile for when their resources start to dry up. And this is their proved and developed resources here. And the base case for that, you can see that actually they look fairly good for about 10 years before it starts dwindling away. But obviously, they can help make the decline a bit less arduous by doing all of these life extension projects. But certainly, we can say from this that they certainly have a good 10 years of runway before things start to get a bit uncomfortable in the conventional space. You can see here the NVP 10, and that actually does match up with their official numbers. And so from that, we can be fairly confident here. And over the next 5 years, even just over the last 5 years, there's obviously a significant disparity here between their market cap and the value of the oil that they're going to be able to sell over the next 5 years. Now, one thing, however, when I went through this report was I noticed that in 2024 there's a massive spike in the capital costs, and that doesn't actually really tie up with what the messaging I've been getting from their analyst presentations and their latest reports. And then from going through the competent persons report, I discovered that they do actually have one offshore asset, which is this Libster field based off the coast of Scotland. And I believe, though, although it's offshore, the actual well linking to it is onshore. There's a nice seismic map of it here. And here we're told that this well was actually discovered in 1996. And although it was actually operating as a oil well, it stopped producing in 2014 because it started turning from oil into gas. So the plan that Star Energy had was to spend some money rejigging the well so that it could start becoming a gas producer. And that was actually planned in 2025. And then when we look here at the proved and developed resources, which would include in the numbers here new projects, we see, well, that well was going to start in that project's supposed to start in 2025 according to this report. And then you see here the gas going up, very significantly, obviously as a result of the Libster field. However, we then also see in 2024 exactly what alerted me to this little detail in the first place. We see the cost jumping up in 2024 to well outside what I've seen in their projections. In their 22 annual report, we see they actually mention the Libster field, and that it's likely that that's going to be a impairment. And in fact, they've already actually spent a few million in impairment charges regarding this asset. So it seems to me that this anomaly I spotted here is that Libster field, And it seems that they decided not to go ahead with that. And I'm not going to go as far as saying that there's a mistake in this competent persons report. I think that maybe the project hasn't been kind of officially killed, maybe. And so it's still in these proved reserves section. It will disappear. Now that then, of course, casts some doubt over, these numbers. But when I look at the proved developed numbers here, and then compare them, particularly over the next 5 years, with the developed only numbers, it's not actually that much of a difference. And so within the nearest £10 million, this NVP 10 over the next 5 years still stands true, and is still substantially higher than the market cap. So looking at the proved numbers here and comparing them to the developed only numbers here, and also in consideration of how successful they are being in doing all life extension projects and how there's a good number of them in the pipeline still, I'm fairly happy to say that this company are really quite undervalued against their oil assets that they're going to be able to produce over the next 5 years, particularly. And also, I'm fairly confident that the the conventional resources are going to still be able to produce quite nice revenues, and they've got a window of at least 10 years before the depletion starts becoming a serious problem. Onto geothermal, and in 2020 they bought this company GT Energy that was running this project in Stoke-on-Trent. Now, in the original RNS relating to that, we'd been promised drilling and it being operational by 2022, but there's been no sign of that. So that does put a question mark over whether that was a good deal or not. But they do have planning consent and a memorandum of understanding with Scottish and Southern Electricity, who will then off-take that heat and deliver it to the customers for them once they've set up the geo plant. The thing is, they're just awaiting government funding before it can start. They've signed a heads of terms agreement with Seraphy Energy to convert a spent well, which is one of their own wells that's no longer producing oil or gas, which is in Lincoln, and convert it to a small geothermal plant. So this is a good project that shows they're taking it seriously, and it will give them experience by actually doing it themselves in one of their own locations in the UK. And then in Cornwall, they've got a heads of terms agreement with Cornish Lithium to convert one of their old mines into a pilot geothermal project. So these projects on their own aren't going to bring loads of money in or be perhaps even price sensitive, but they are both putting the foundations down for them to show proof of concept and create like a product that they can start selling even in the private sector. And only recently this year, they've achieved preferred contractor status for two NHS projects, one in Manchester and one in Salisbury. And the next steps for that are forming what's called a innovation partnership, and then they'll need grant approval. So they should get less than 2 million of government free money to then allow them to allow them to start doing all the testing and drills and stuff that's required to then be ready to start construction. And the idea is that the testing and design will be completed by 2025, and then they'll just need a 25 million final investment decision before they can start construction and operation. I've got here a slide from their most recent presentation where you can see the different steps of this project, and this is for Salisbury. And what is good about these UK projects is, first of all, they grab free UK taxpayer money to do all the initial work, and then and it looks like they get grant actually even for the construction part as well. But I think some of that also have to be funded themselves. Um, and then when the project's set up, then they will be selling the heat to the local hospital, over a long period of time. So these UK projects, what's good about them is they get lots of the money up front. They don't really need to put much money in themselves up front. There's lots of free government green renewables are great money to allow them to get these going, and then hopefully build up a portfolio of geothermal in the UK. The other thing, though, is the value from each of them isn't all that much compared with their overall revenues they get at the moment. Each individual project isn't much, so they're hoping for to grow perhaps to like 20 or 30 projects throughout the UK before it will be a money maker of any significance. We're going to have to wait quite a few years before we start getting price sensitive news flow with these projects. And they just this year bought 51% of A14 Energy for 1.6 million euros plus 1.5 million euros they're going to have to pay later. I listened to their description of this in their latest investor presentation, and it does actually make good sense because Croatia is actually one of the best suited countries in Europe for geothermal. And whereas in the UK, the water's not quite so hot, so it's good for heating only and perhaps is less profitable. In Croatia, the water's so hot that it can be used to do little power plants. So these Croatian projects will end up with these little power stations providing electricity, and they're talking about 10 megawatt plants. Now, there's actually with the company that's the subsidiary actually doing all the work here in Croatia. There's already one license here, the Ernestinovo license, where actually they've got to do another test well. It's in an old oil well. Then they're going to be able to apply for a development license, which they're hoping to do next year. And then by 2026, they should be drilling the production wells, and 2027 actually building the plant. Apparently, it will require about 60 million of capex. So they may need to raise some money to help with that. This is a very tangible geo project, in a country where it makes sense. They've also this year just been awarded two exploration licenses as well, with a third one we're waiting the outcome for. This endeavour is certainly going in the right direction. The exploration cost here will be about 30 million, but that's going to be covered actually by their partner GTEC, who own the other 49% of this company they've bought out, and that will be repaid from revenue. So it's all exactly the same actually as with the UK. For the foreseeable future, there won't be too much costs in bringing this forward for Star Energy, and then only when it's significantly de-risked in about 4 or 5 years' time, when they're ready to be building these plants, will they then, have to perhaps start taking some risks. Overall, it actually looks like a very good common sense plan they've put together here in how they're moving into geothermal. But I think it's important to point out that they're all relatively small in terms of money makers. So they're having to have like quantity rather than quality in terms of how much they're getting from each project. And the other thing is, we're not going to get the positive news flow until about 3, 4, 5 years time. So I wouldn't be relying on the geothermal to spike up the share price, in the next year or so. I think that's more for in a good few years before the geothermal could start seeing the share price racing up. Do a quick summary so far. So for me personally, although I think it's great, I'm not really that interested in the geothermal. I look at it as perhaps more like a bonus in the future. For me, what interests me about Star Energy is they appear to be seriously undervalued in terms of when you compare their market cap against their 2p NVP10. And even if you just slice out the next 5 years from that, they do look seriously undervalued. I am interested in investing in them just purely because of how undervalued they look. And then the geothermal, that's a bit like a bonus 5 years down the pipe. So now to have a look at the history of the company. And back in 2014, when we had the credit crisis, the price of oil dropped from $110 a barrel to only $50 a barrel. And this led to a colossal drop in their revenues. And because they are quite a high cost producer of oil because their projects are end of life, this put this company on the verge of bankruptcy. And you can see in 2015, 2016, their their income was horrendously outweighed by their expenditure. And as you can see, they were burning through 30 to 40 million a year in terms of cash burn, and they were in a real bad state with actually over 100 million in debt. And what then happened was it was probably some kind of haircut deal actually, but um, they had a capital restructuring, and this company Keragen Capital came in. The share price obviously, well, it dropped loads, but it dropped more, I think, when this happened. But there was obviously a dilution of shares, and actually, I think they even had a share consolidation as well. So you can see here the total destruction in the share price. But this did actually allow this company to survive as a going concern. And Keragen Capital ended up with 28% of the shares. And in return for that, they helped them pay off all their debts. So you see then that from 2017, their debt was substantially reduced. And so because they weren't having to pay off massive interest on their debt, well, actually, a lot of this is actually them having to write off a lot of their shell assets. But then because local councils were banning them from, even though shale wasn't banned, the local councils, I think Blackpool was one, weren't letting them drill in their local areas. So they're having to write off um, their some shale assets. And then in 2019, the government then properly did ban fracking. So you can see they're in a terrible state. And then, of course, in 2020, there was the COVID drop. So this company has been through so much trauma over so many years. I mean, it really is quite remarkable. I don't think I've seen a company so punished for such a extended period of time. And their situation was that part of this takeover deal meant that they used to have to hedge the oil that they had. And you see here the derivative instruments. You can see here derivatives being a significant number each year. So they were having to hedge their oil because it really was the case that if they didn't, any drop in the oil price and they'd be just bankrupt. And so the company really has been through the wars, and you can see the UK, the share price here from 2019. You can see here where the UK government announced the fracking ban, because before a lot of the share price had been a kind of speculation over their shale assets being a thing. You can see, however, in 2021 they started to move into geothermal by buying GT Energy and then taking over this project in Stoke-on-Trent. In 2022, they had this new chairman called Chris Hopkinson, and it was all a bit auspicious how later in the year their CEO then got booted almost kind of with very little explanation. And then this guy, Chris Hopkinson, who kind of came in here, then all of a sudden takes over as CEO. In 2022, of course, and this was when I came in, when Liz Truss got elected, the government lifted the ban on shale. And you can see this massive pump up in the share price. But it really was a case of buy the rumor, sell the news, because literally a few weeks after the ban on shale was lifted, Liz Truss was forced to resign in very dubious circumstances, and then Rishi Sunak came in, and then he, of course, then immediately banned fracking, and then so that explains this rug pull, pump and dump here we see with the Star Energy share price. And then in 2023, they've had success in getting planning permission for the Glentworth development. That's this project here in green. And they bought 51% of A14 Energy for 1.6 million, as I described earlier. And as I described earlier, this new enterprise has already just been awarded 2 exploration licenses. So I'll do the shareholders now. This is quite relevant to the history of the share price. See here Kerrigan Partners, who are part of the original rescue deal, and these other guys. Now, what's interesting is you see that with this pump here, that coincided with Sandgrove Capital, O'Day Asset Management, and JP Morgan Chase all coming in and buying substantial quantities of the overall stock float. And then this crash in the share price then coincides with O'Day Asset Management and JP Morgan Chase totally getting out of Star Energy. Also, while they were all at it, Bank of America have also this year got completely exited this company. And then we have Sandgrove Capital, however, of these 7, they're the ones remaining from these sellers who had significant drawdowns, and they still own 10% of the stock. So considering how undervalued this stock seems to be, for me, I really am wondering if, we've had the rug pull now, and maybe the selling was exaggerated because all these big players coming in, inflating the price, and then exiting, dumping the price. And hopefully, maybe we should go through this, maybe even now in this kind of bottoming out period. But I can't help but think that it might be an idea to wait for Sandgrove Capital to finish off selling all their shares before you can kind of go in to this stock without the price being perpetually depressed by that holder of 10% of the shares. So looking at the numbers, and by the way, if you go into the first video I did a year ago, there's a lot more detail, and I go into the numbers actually in a lot more detail. Also in the one I did 5 months ago, there's obviously all kinds of asset write-downs, debt issuance, and all kinds of complexities. But and even in 2022, they had this final write-down of their remaining shell assets following the government ban. So actually, the 2023 interims are the first time that we have a nice clean set of numbers without all these hideous anomalies spattered all over the place. But of course, in 2022, they had a good year in terms of their revenue, and that's because we had a real bumper year in terms of oil prices in 2022. And this year, we've had great oil prices as well. And we're currently at $89 Brent. So last year was a great year. I went into a lot of detail about that actually in my video I did 5 months ago, but their revenue they're getting from their conventional assets is doing great. Their depreciation and their cost of sales and admin, that's all in line as per the interims as it was with the numbers last year. so their costs aren't really getting carried away. And other than that, we've got a lot of this these distractive junk gone. Um, you know, these are looking really good, and they actually turned a profit. They actually turned a operating profit of 6 million, and I can say from both looking at the numbers and also from what their CEO said at the last update, they're looking at around 14 or to 15 million of free cash flow every year. How depressed the share price is compared with how it was recent years. But then actually the reality is that compared with what was going on operationally these years, they're actually now doing quite well. Now, one complication is these tax credits, which is where, as a oil stock, all these years they were losing money. They were allowed to claim deferred tax assets, and that currently is now 42 million. And so now that they're making money, they have to actually pay these deferred tax assets. And at first, I thought this really was just kind of accounting mumbo jumbo and not really a proper asset. But actually, it is quite well marked out in their 2023 interims here. And you can see that actually, yet they have to pay 3.7 million as a tax charge. But interestingly, when I look at their statement of cash flows, I don't see any money, any real money, actually having to be paid to the taxman. So, yep, in terms of their profit and loss statement, it goes as a negative 3.7 million as they cash in these tax credits. However, in reality, they don't actually have to pay any money. So it is actually, these tax credits are actually a real asset. And as long as they still have a balance of tax credits remaining or deferred tax assets remaining, they're not really going to actually have to pay any money out of their cash flow to the taxman, even though on paper it will reduce their overall net income. So in terms of their revenues, as long as oil, by my rough estimation, stays above about $20, I think this company is in actually quite a healthy state now in terms of their conventional assets and revenues. And and we can expect to see them in profit with substantial cash flow and not even having to pay the tax to actually physically to the tax man as long as these deferred tax assets remain. Zooming in on their current assets, and in my earlier videos I go into detail in the previous years as well, but I'll just stick to the this year. And in terms of their current assets and liabilities, they are able to cover their short-term payments with the trade receivables and inventories, and also cash on hand. The only thing, though, being this 5 million that they have as short-term debt. So it's amazing to see that in terms of their long-term liabilities, they're now actually debt-free, and that's now been moved to their short-term debt. And they announced at their investor presentation that they're going to be fully rid of debt by June next year. So this balance sheet is kind of going from basket case to actually quite a healthy balance sheet. Really, their assets, the most significant thing about their assets really are their property, plant and equipment, which is obviously all of their production facilities they have dotted around the country, and the deferred tax assets. So I've got that here in a little graph. And the thing is, the deferred tax assets, when I like rank different assets as of being different quality, they're not the most highly desired of assets, but still they are fairly tangible, as I've demonstrated earlier when you peek into the cash flow statement. The property, plant and equipment, that's obviously for their existing conventional resources. And the thing is, over the next 30 years, you can expect this to diminish to zero as all of the all of that stuff basically just ends up being kind of scrap metal eventually when the oil isn't produced from the wells anymore. But still, really, frankly, we've got, when we look at the market cap here, this company does appear to be undervalued based on their price of book. And then even if you were to say that the PPE, well, it's all end of life wells that the value is going to amortize away, and then there's no recurring revenues from those sites and equipment. Even if you were to take away all this PPE, they're still kind of fairly valued. Um, and I'm probably being very harsh on them, discrediting these assets even. So frankly, look, guys, there's a price to book of 0.2 here, and you're looking like a 30-year period, I'd have thought, to degrade these assets. On the debts, a lot of this debt is provisions, which is the cost of returning to nature all of those oil wells once they've been finished use. So other than that, there's no real debt. When I look at their profile here, I do think they're undervalued, but absolute worst case, you can say that they're fairly valued here in terms of their price to book and their actual valuation against their pure net assets. There's a lot of upside here in terms of them being, undervalued in terms of their oil assets. They've got future revenues surrounding that. So I've got here their net income history, and you can see how now, after being disaster zone all those years, they're now actually the expenditure is lower than their income. And with this graphic, you can see the scale of, from when you go back to 2015, just how immense the kind of atom bomb that dropped on this company. Now they look at their market cap against their net assets, which I've gone through already with their price of book of 0.2. So if you just take their next 5 years NPV 10, they look quite incredibly undervalued. So to summarize, I'm not really interested in the geothermal part of this business, although I think I think they're doing a good job of it, and that could be a great bonus 5 years down the track. But for me, I'm very interested in Star Energy because I do believe that they are seriously undervalued. So even though I got badly burnt last year with them, I am seriously considering making them my high risk, high reward bet for this year or possibly next year if I don't do it in time this year. I am interested. There's just two things that are kind of holding me off at the moment. One is there's been a lot of bad macro news recently, particularly around the bond markets, and I just want to wait a bit, let that peter out a bit, and make sure I'm confident in the stability of the kind of global financial system over the next couple of months, and keep an eye on oil price, because the most important thing to realize about Star Energy is they're doing great now, but the moment oil starts dropping below $70, I think then they kind of shape shift from being a company that's doing great to a total disaster. So you've kind of always got that over your head, which is why they are like a high risk, high reward play. I want to keep an eye on oil price just to let it settle given recent turbulence. Have a look at the global macro situation, because a macro disaster would then lead to a disaster with the oil price. And while I wait a bit just to de-risk a bit there, I'm also then going to be looking out to see if Sandgrove Capital complete their drawdown of stock. So I'm going to give it a bit of time. The share price has actually been acting quite strangely lately. You know, there's a kind of a big margin between buy and sell. There's actually low volume and a big margin between buy and sell. You can see it better actually on the daily at this scale. So yeah, you see, it's a bit strange. And I suppose actually, to be fair, this is the usual margin you get with Star Energy, but it's just that why is it just flat? I'm certainly going to wait them out a bit, have a look at the macro situation, see if I can smoke out Sandgrove Capital a bit as well. If I'm a little bit more confident about the macro situation, I do think that Star Energy could be a good speculative bet with only 2% of my overall portfolio value. So I've summarized there my rationale. So I do hope you've enjoyed this video, and have a good weekend. Please read the disclaimer and remember that prices can go down as well as up.